Next up, we have Miss Fredicia. She is going to explain to you the money part, the very important part and the first part of any home buying purchase, because without the money, we're not buying anything.
This is true. Thank you, Jane.
Thank you.
And thank you for this awesome opportunity to be with you guys this morning. I am Fredicia Money. I'm with Fidelity Direct, and I've been in the business possibly longer than some of you are living. But don't hold that against me. I started long before child labor laws came into existence, and I totally enjoy what I do. I'm very passionate about it. As Benita mentioned, she is, because I believe that everybody deserves a piece of the rock. Everybody that wants to own their own home should, and more importantly, should understand the financing piece so that they can maintain their home. When I started in this business, interest rates were in excess of 18%. So when they look at me today and say 7%, I'm like, would you like 18? But that being said, FHA introduced the graduated payment mortgage to help people avoid the 18% interest rate. The problem was people didn't understand that tool. Mortgages are nothing more than a tool to help you acquire your real estate. So the 18% with the graduated payment mortgage, the payment was very low and eventually after 7 years went up. It was not an adjustable rate. This was a fixed rate. My point in telling you this, when I met some of those sellers now getting ready to buy something else, they didn't understand why they owed more on the house than when they bought it. All they saw was, get me in this house happy. They had the incomes, but did not make the actual note payment, which they could. Today, I assure you, as your lender of choice, you may not understand my industry, but you will understand what you're signing your name to. Because at the end of the day, you've got to pay it. And you want to be able to enjoy it. You want to be able to own the home versus the home owning you. You want to go on vacation, like I just got back from Hawaii, you should be able to continue your lifestyle, okay? Home ownership should not detract from your lifestyle. Rather, it should enhance your lifestyle, okay? So we're going to look at some of that today. And you have lots of information. Oh, I got to tell you this. I'm not going to tell you the whole joke. But anyway, because in this industry, you better be prepared to laugh. Otherwise, you will have a lot of gray hair and always at the hairdresser getting the color, right? So anyway, you're going to hear a lot of good stuff today. Some of it's going to be absolutely overwhelming and almost unbelievable. I assure you that everything you hear from every speaker, every presenter today will be the real deal. Because we want one thing, for you to acquire real estate, to start your wealth legacy or continue your wealth legacy through investment properties if you already own your own home. To the young lady in the back, Shalita, I think it is? Yes. You asked a question about should you borrow, should you, what'd you say? Refinance, pull cash out. Okay. As Jane said, it's going to be a personal matter, but I do encourage you not to use your house as an ATM machine if you can avoid it, okay? If you want to ultimately own the home especially. But yes, there are going to be restrictions and limits as to how much we're going to let you pull out, and that's a protection feature for you, okay? All right, so with that, we are going to talk about 4 categories. Benita did a great job on credit. I'm not going to spend a lot of time there. But before I do, I want you to think about, what's your goal? What's your plan? What kind of property would you like to own? Do you want to live in it, or do you want to buy it to rent it out? How soon do you want to be in your own home? Because our plan, our purpose is to service your needs. The sooner you buy, the better. But at the same time, we need to work within your plans and your goals on this journey to get you home, okay? So, 4 categories. We look at your capacity, your credit, your capital, and collateral. Now, what in the world is capacity, Fredicia? That's your income. We look for a 2-year history of employment, but if you haven't been employed for 2 years, but you do have a full-time salaried position, we can still offer financing if everything else works, okay? let's say you're working 2 jobs, but you haven't been on that second job 2 years or more at the same time as your regular full-time job. We're not going to give a lot of credit to that second job because you might wake up and say, I do not feel like being bothered with Nordstrom today. I'm going to sleep in. I'm not going to work. So if we don't have a consistent 2-year history of that part-time employment, it's only going to be a compensating factor. I tend to talk a little fast, so if I go too fast, somebody say, slow down, Fredicia, okay? You know, money's always running, okay? We want it running towards you.
Money like speed.
That's right, money like speed. Okay, capacity. Self-employed. We have products developed specifically for self-employed people. Okay, most realtors, most insurance providers, such as Mr. Chesley in the back, such as Scott, who was not able to be with us. That's his name, right? Okay. We are kind of like self-employed people, and we have the propensity to make a lot of money and hide it all until we get ready to buy something. So because your hairstylist or whatever entrepreneurial endeavor you're involved in may not show us the money we need, so you got to show me the money. We have a product called a bank statement program or a profit and loss program designed specifically for self-employed borrowers because they make a lot of money and they hide it all. So I don't want your tax returns. They're only going to give me a headache because they're not going to have the right bottom line. So we'll develop an income based on your bank deposits, okay? So that's also part of your capacity to repay. Everybody is not a salaried employee. We have programs for them. Next slide. How much can your income support? How long you've been on the job? Do you work part-time? We covered all of that. Next. Okay, open all those. And the only thing I'll say in addition to what my colleague Benita has shared with you is that we make loans with scores as little as 580. Obviously, the better your score, the better your program and interest rate options. Money is always risk, R-I-S-K, risk-based. What are you bringing to the table? Okay, hold on. Go back. Oh. Anyway, as little as 580. If you have a 560 and have a boatload of money, I can still help you because I'm going to be looking for at least 10% down with the 560. However, it's really to your advantage to work with Benita to get that score in the 6s, preferably above 640, because that's the magic number when you want some OPM, other people's money, like those special programs, down payment assistance programs, Maryland Mortgage Program, the City of Greenbelt currently, if you're already a resident of Greenbelt and have been a resident for the last 12 months, has a special allocation of money to help you buy. So there are lots of strings attached, but there's lots of free money or money that if you meet the criteria after a certain period, it is totally free. So 640 is that magic number to get you into those specialty type programs. But if you have all your own money, 580 is the bare minimum. But again, we want to get you well above 580 because the difference in a 580 score and a 640 score when it comes to interest rates, and so much to say. Okay, interest rates are nothing more than a commodity to finance your property. They have a price tag. That's what I'm getting to. So if you have a 580 score versus a 640 score, that interest rate of 5.75 is going to cost you more at 580 than it would at 640. And points add to your closing costs. I will try not to talk with my hands. Points add to your closing costs. We have a slide coming up, but I need to mention right now the price tag. You can go to Nordstrom, buy a suit, or you can go to Ross and find a suit. The one at Nordstrom's going to cost you more, but it's going to do the same thing. Protect your body, provide clothing. Why does it cost you more at Nordstrom? Because it's supposed to be more stylish, provide more comfort, give you a certain class. You can have a 5.75 rate, or you can have a 7% rate. They're both going to do the same thing, finance your house. But one is going to cost you more. Guess which one? Anybody? 5.75. The lower your rate, the more points you pay. And the lower your score, the greater points you pay for that same 5.75. Make sense? Okay, moving right along. Capital. Show me the money, baby. You cannot save money in the mattress and suddenly go put it in the bank without an explanation. So, we've got to know where the money came from. Ever since the tragedies of 9/11, where it was traced back to terrorists refinancing real estate, buying real estate, flipping it, and funding those acts, source of money has become very scrutinized, has been scrutinized, almost worse than income. You have to show where the money is coming from to buy the house. Remember those down payment assistance programs? There's a grant called Federal Home Loan Bank Grant Program that will give you money. You're still showing us where it came from. We help you get those grants. We help you with those down payment assistance programs. But if you have the money at home in the cookie jar, that's going to be a problem, okay? There's ways around that. So basically, your money needs to be seasoned for at least 60 days. So if you hit the lottery, that's one thing. You can show me a ticket. But otherwise, put the money in the bank now so that your beginning balance and your ending balance makes sense over time, okay? Oh, go back. Like I said, you cannot just come up with, oh, okay, well, that's okay. You cannot just come up with the money. We have to know. Now, if you don't want to answer my questions, show me you got $450,000, conversation's over. But if you need my $450,000, you're going to answer my questions, all right? Let's say somebody wants to give you the money. That's great. Depending the type of financing, which we'll talk about in a minute, depending the type of financing, they simply need to sign a form saying they gave you the money. They need to show a bank statement that they have the ability to give you the money, and then they need to either give you the money now or provide it at settlement from that same bank account that they showed us, okay? So there are ways to come up with the money. Collateral. Before we get there, we've looked at your income, we've evaluated your credit, you've shown us the money, whether you have enough now or by the time we're ready for settlement, you will have accumulated enough money. Then you go out and we've qualified you to tell you how much of a house you can buy. Yes. Oh, you can't just come up with it. You're welcome. So, income, credit, funds to close, we come up with how much you can qualify for, then you and Jane and her team go out and find the property, negotiate the contract, then you pay for an appraisal on the collateral being offered. The lender does not upfront the cost of your appraisal. We're not buying the house. You are. Appraisals run anywhere from $550 and up. What is the house worth? You and the seller have agreed on a price, but we, the lender, have to know for sure, and that's done by way of the appraisal. What happens if it doesn't appraise? Well, it depends on your contract offer, and Jane will get into that more, but it can become a negotiable item. On a government loan, it pretty much either gets reduced or you come up with the money. Conventional, it may or may not be consequential. Next, acquisition, sale price, closing costs, prepaid items, minus your loan amount, minus your deposit, known as earnest money, minus any credits, gets you the keys to the house. So, is there something I can push up here so you don't have to jump up? Okay, you got to jump up then. Can you go back? Sorry. That whole slide, because I want to spend a minute there. One more. Perfect. Okay. Acquisition. What is it going to take for you to acquire the house of your dreams? There's a sale price. There are closing costs. Closing costs are nothing more than the legal items required by the county, state, city jurisdiction to transfer that property title from their name to your name. Prepaid items, things that are paid for in advance associated with owning a house. When you go to settlement, you start using the money, you're going to prepay some interest. People that go to settlement on Monday, March the 6th, are going to pay interest from March 6th until the end of the month. They will then skip April 1st and make their first mortgage payment May 1st. Mortgage interest is paid backwards. Unlike rent, when you make a rent payment, you pay for living there that month. Mortgage interest is paid backwards. Even though we tell you no late charge is assessed until the 15th, that payment's technically late on the 1st. But we won't hit your credit unless you don't pay by the 30th by the end of that same calendar month. Follow me? Other prepaid items, insurance. Lloyd is going to talk to you about property insurance. We lent you $450,000. That's your mortgage amount. Your insurance coverage is going to be close to that. We have to see 1-year policy paid in advance because, Lord forbid, you don't make your payments and the house burns down within that first 12 months. There's insurance to rebuild it. Property taxes. In Maryland, for the most part, they're collected every 6 months. So we're going to collect taxes 6 to 8 months at settlement. And when you make your mortgage payment, 1/12 of the taxes, 1/12 of the insurance is added to make your total monthly payment. Okay? So you got your sale price minus your loan amount, minus your deposit, minus any credits that the seller may be paying, minus any grants that you got. That's how you get the keys to the house. Does anybody have any questions on that process? Wonderful, I'm doing a great job. Okay, next slide. Mortgage insurance. Because there's a small down payment, mortgage insurance is required in the event, unfortunately, of default and subsequent foreclosure. If you put down, there are 3 types of loans. 2 really, but we'll say 3. Okay, so you have your government loan, which is made up of FHA loans, Federal Housing Administration, and VA loans, Veterans Administration, but you actually don't have to have military service. There's lots of categories that may qualify a person for a VA loan, so we can talk about that offline. And then there's USDA, which is kind of government, but it's more conventional. And then you have your conventional, which is the standard, normal way to finance. Before any of those government programs came along, it was only conventional financing. 20% down or you didn't get a house. So over the years that has changed, and now if you do put down 20% on a conventional loan, there is no mortgage insurance, no risk insurance, because you've got a big piece of the pie. And we know you're not going to risk losing that 20% down payment that you put in. It's less likely. On the other hand, the government loans were developed to help people that didn't have 20%. So consequently, an FHA loan will allow you to put down as little as 3.5%. On a $500,000 property, 3.5% is less than $20,000 that you've invested. So yes, you have to carry mortgage insurance. The good news is FHA recently agreed to reduce the monthly mortgage insurance. Lots of information. So not to just take my word for it, you can buy more house now because FHA's insurance went down. VA loans, 0 down payment if you qualify with zero down, and you have full eligibility as determined by the Veterans Administration. And even if you've used your entitlement previously, you can still get maximum financing in certain scenarios. And then also with the VA loan, if you are considered any percent disabled, you do not have the risk insurance as our way of saying thank you for risking your life for our great country. Then there's the USDA loan, which can also offer 100% financing. So that's mortgage insurance in a nutshell. Yep. Stop there. So there's an example of what I mentioned to you. On a 350, 3.5% down payment is $12,250. Base loan amount, $337. Plus FHA's lifetime mortgage insurance of $59.10 brings you to $343,660. It almost looks like you didn't make a down payment, but you did. Make sense? Questions?